Imagine a man in a suit who promised to make you rich but instead left thousands of people broke. That's Bernie Madoff, the mastermind behind one of history's largest and most notorious Ponzi schemes, which collapsed in 2008. So what is a Ponzi scheme? It's an illegal investment fraud where returns to existing investors come from funds paid by new investors rather than from profit earned through legitimate business operations. The system can continue only as long as there are new investors to fund the payouts, and it eventually collapses when insufficient new money enters the system or too many existing investors request withdrawals. Let's rewind to December 11, 2008. Bernie Madoff walks into the SEC offices with his son and confesses, "I have a Ponzi scheme." He had run one for decades, promising returns that were far higher than typical market averages, which is impossible to sustain in real markets over such an extended period without new capital inflows. Here's how it worked. New investors put money into Bernie Madoff's operation. Instead of investing that cash, he used it to pay earlier investors. The longer people stayed with him, the more they believed they were making significant returns, but really they were just receiving back their own money plus a little extra from new participants in the scheme. Bernie Madoff told his clients, "Trust me, I'm making you rich." He was so convincing that even sophisticated investors fell for it. His firm appeared legitimate and received glowing reviews. Everyone wanted in because the returns seemed too good to be true, but no one wanted to admit it might actually be a fraudulent scheme. But like all Ponzi schemes, Madoff's needed constant cash inflows to pay earlier investors. In December 2008, during the financial crisis, securing new investments became more difficult. That's when the scheme began to unravel. The collapse was swift and severe. Investors began requesting redemptions en masse, which Bernie Madoff could not satisfy with incoming funds. This inability to meet withdrawal demands caused the scheme to unravel rapidly. When it all came tumbling down, Bernie Madoff's Ponzi scheme was revealed to have defrauded his clients out of approximately $65 billion. This amount is significantly larger than what could have been earned through legitimate investment practices over the same period. Let's break this down. Bernie Madoff had approximately 4,800 investors worldwide. Many lost significant portions of their life savings and retirement funds. For context, the median American household net worth was around $123,600 in 2020, according to Federal Reserve data. So imagine losing a substantial amount or more overnight. To put it in perspective, if you stacked $1 bills on top of each other for every dollar Bernie Madoff is estimated to have defrauded, the pile would reach approximately 348 miles high, which is much taller than Mount Everest's peak at 29,032 feet, 5.5 miles, and higher than any building ever constructed. Subject: the collapse of Bernie Madoff's Ponzi scheme. Now here's a myth to shatter. Ponzi schemes only happen with greedy individuals. Not true. They can involve people who appear reputable and respectable. Madoff was clever enough to make his scheme look legitimate on paper, attracting respected financial firms as clients, which made it seem trustworthy. But there were warning signs all along the way. For example, how did Bernie Madoff achieve consistently high returns of around 12% annually, when most investors struggle to match the long-term average return of the stock market, which is closer to 7 to 10% after accounting for inflation? It's like finding a needle in a haystack. Another red flag: Madoff's firm didn't have an independent auditor. Most proper financial institutions use third-party auditors to verify their books and records. The absence of such oversight meant that the numbers could be manipulated as desired without external verification. The real kicker: when his scheme collapsed in 2008, it wasn't just Bernie Madoff who suffered. Thousands of investors lost billions of dollars. It's like taking a sledgehammer to a retirement fund that was built over decades through hard work and sacrifice. Imagine this scenario. You retire with a nest egg, expecting to live comfortably off the returns. But one day your advisor tells you that all your savings are gone, vanished into thin air because of a scam artist's lies. That's what happened to many people in 2008 when Bernie Madoff's Ponzi scheme collapsed. This story isn't just about Bernie Madoff. It's a cautionary tale illustrating how financial systems can collapse when greed and deception are allowed to thrive unchecked. It underscores the importance of transparency, regulatory oversight, and thorough due diligence in safeguarding investors' interests. So here's the lesson. If something seems too good to be true, it probably is. Always ask questions, do your research, and never trust blindly. Bernie Madoff operated a massive Ponzi scheme that convinced investors they were earning substantial returns when in fact he was using new investments to pay earlier ones without generating real profits. But let's look at one concrete example of how this worked. Imagine you invest $10,000 with Bernie Madoff. He pays you back 12% each year, which is $1,200, but that's not profit from investments. It's your own money plus new investors' cash. So after 10 years, assuming no withdrawals and the same returns, you'd think you have $25,692, the result of compounding 12% annually on a $10,000 investment over 10 years. In reality, Bernie has taken all your original $10,000 back out of his fund. The math is simple but deadly. If there's not enough new money coming in to cover payouts, the scheme collapses quickly. And that's exactly what happened when Bernie Madoff's Ponzi scheme was revealed in late 2008, as the financial crisis made it increasingly difficult to attract new investors. Subject: the collapse of Bernie Madoff's Ponzi scheme. Now let's dive into some numbers. Bernie Madoff had around 40 employees at his firm. Yet when investigators looked through the books, they found no evidence of real trading activity. Instead, there was a sham system designed to pay out earlier investors using new ones' cash. To keep it going, Bernie Madoff needed to bring in millions every month. How did he do that? By making his scheme appear lucrative on paper and convincing investors with exaggerated promises of high returns. He played the long game, seducing clients over years with consistent but fictitious returns that seemed too good to be true. But here's a key point. Even if Bernie Madoff's scheme appeared sound on paper, it was built entirely on deception. There were no actual investments supporting the reported returns. It was simply an elaborate shell game involving participants' funds. So why did so many smart people fall for this? Simple psychology. We want to believe good news about our finances. When someone promises steady returns and offers what appears to be a solid track record, it's easy to overlook the red flags. People saw consistent results year after year and thought Bernie Madoff was a genius investor when in reality he was merely very skilled at conning them. Another reason is trust in authority figures. Bernie Madoff had connections with prominent individuals and respected financial institutions. When potential investors saw that high-profile and reputable clients were involved with Madoff's operations, they often assumed it must be legitimate, even when the underlying mathematics of his returns seemed inconsistent or suspicious. The collapse of Bernie Madoff's scheme underscores a broader issue: the importance of robust regulation and oversight in financial markets. Such measures are crucial to prevent fraudsters from operating unchecked for extended periods. Without adequate safeguards, Ponzi schemes can flourish by exploiting investors' hopes and fears regarding their finances. Now let's look at another concrete example: how Bernie used new investors' funds to pay earlier ones. Imagine you invest $50,000 in 2008. By 2010, if you left it there without withdrawing, you might think you have over $73,000 based on the promised returns. But what really happened is that your original money was returned as part of those higher returns, while new investors' cash paid out the rest. This creates a false sense of security and growth until there's no longer enough new money coming in to pay previous investors. When this happens, the scheme collapses suddenly, leaving all participants at risk. One key aspect of Bernie Madoff's operation was secrecy. He maintained strict control over his records, allowing only he and a few trusted insiders access. This made it difficult for regulators and auditors to detect the fraud early, despite clear warning signs that could have been identified with closer scrutiny. But here's the twist: despite these red flags, Bernie Madoff managed to operate the scam for nearly 2 decades without getting caught. It shows just how clever he was at fooling people and institutions alike. He made his scheme look so professional that many simply assumed it must be legitimate, even as signs of fraud mounted. This brings us to a critical lesson about due diligence. Always ask tough questions before investing your hard-earned money. Do not accept promises at face value. Investigate the investor's track record, verify their credentials, and critically evaluate any claims that seem unrealistic. For instance, one way to spot a Ponzi scheme is by looking at the returns offered. Consistent high returns without corresponding investment risk are almost always a red flag. Bernie Madoff promised steady 12% yearly gains, which would be highly unusual and unsustainable in real markets over long periods. But let's circle back to the human element. Why do people fall for such scams? It often comes down to hope versus fear. People see consistent returns as proof of exceptional investment strategies or insider knowledge, not realizing that in reality it's a deceptive illusion created by fraudsters like Bernie Madoff. Another significant factor is trust in authority figures. When you see respected names endorsing a financial product or service, it can feel safer and more credible, even if logical analysis suggests otherwise. This cognitive bias allows individuals to overlook warning signs because they place faith in the perceived legitimacy of powerful networks and prestigious institutions. Now let's zoom out to look at the broader impact. Bernie Madoff's Ponzi scheme affected thousands of investors worldwide. Many lost significant portions of their life savings or saw decades of retirement planning vanish overnight. It was a devastating blow not just financially, but emotionally, as people realized their dreams were built on lies. To put this into perspective, if you had invested $100,000 in Bernie Madoff's scheme and didn't withdraw anything for 25 years while receiving the typical annual return of about 10%, you might have expected around $673,000 by the end based on compound interest calculations. However, what you actually get is zero or a negative balance due to unpaid returns and penalties once the scheme collapses. This is like being promised a big reward but receiving nothing in return. The contrast between expectation and reality is stark. People believed they were on track for financial security only to face ruin due to Bernie Madoff's deception. Now let's talk about the ripple effects. When Madoff's scheme collapsed in 2008, it didn't just hurt his direct clients. It also impacted other businesses and individuals who had trusted him as a reliable partner or investor. For example, charities and nonprofits that invested with Madoff found themselves in dire straits overnight, unable to fund projects, provide services, or meet their missions due to the sudden loss of significant assets. This demonstrates the far-reaching consequences of financial fraud. It's not just about individual losses, it can affect entire communities and industries. When a major player collapses, it can have ripple effects that impact everyone else involved. So what can we learn from this? First and foremost, be skeptical of guarantees. No legitimate investment provides guaranteed returns without corresponding risk. If someone promises consistent profits every year, it's often a sign of fraud or deception. Secondly, always conduct thorough research. Before investing in any scheme or opportunity, verify the credentials of those involved. Seek out independent audits and third-party validations. Do not depend solely on positive reviews or word-of-mouth recommendations. Delve deeper to understand the true mechanisms generating the returns. Lastly, never underestimate the importance of due diligence. Whether it's reviewing financial statements, asking thorough questions, or seeking advice from trusted experts, these steps can help protect you from falling victim to a similar fraud. Subject: the collapse of Bernie Madoff's Ponzi scheme. Now here's a final mythbuster. Ponzi schemes aren't just for greedy individuals, they can also be part of institutional fraud. Remember how Madoff had respected firms and high-profile clients. This shows that even sophisticated financial systems can fall prey to deception when oversight is inadequate or non-existent. So what does this mean moving forward? The lessons from Bernie Madoff's collapse are clear. Transparency, regulation, and vigilance are essential in the world of finance. Robust checks and balances are necessary to prevent fraudsters from operating undetected for extended periods, preying on people's hopes and fears about their financial future. In summary, Bernie Madoff's Ponzi scheme was a catastrophic failure that shattered lives and exposed vulnerabilities in our financial systems. It serves as both a cautionary tale and a call to action. Be wary of guarantees of high returns with little risk, conduct thorough research on investment opportunities, and always question the status quo when it comes to your investments. This is educational and historical, not financial advice.